Very warm welcome. Welcome to HYCM's workshop with myself, Giles Coughlin, a Chief Currency Analyst. Very happy to be here. Looking forward to getting us ready for the main trading event of the week, which is the US CPI print. I will, of course, just go through the market. Don't forget to use the question and answer and chat box. I will be keeping that open, so if you have any questions as we go along, please do pop them in. We'll be looking at how to trade the US CPI meeting tomorrow. I'm going to be running through why this is so important, giving us the broader context of the importance of this inflation meeting, and showing you the best instruments for trading it. Now, I'm just going to open up my other screens, and I want to sort of take us through some of the key aspects for this trade. Right, I'm just going to move screens. But just don't forget, as I'm talking through this, everything is from an educational perspective. It's not a signal trading service, so just to make that clear with that disclaimer. Okay, brilliant. Right, now, if you take a look at this screen here, this is the Fed Fund futures. And what this tells us is what the expectations actually are for the Fed's rate hikes. And what we can see is that the futures markets for the Fed are expecting 1.34, so that's 134 basis points of tightening coming from the Fed this year. Do you see the way these Fed Fund futures have been moving higher and higher and higher? Well, that's been because the Fed has been worried about inflation. Now, what is inflation? Inflation is just the costs of goods and services. Most people are quite aware of inflation now because it's been in the news and the headlines. But if you look over the last sort of 10, 20 years, inflation has been very low in the Western world. So when inflation rises, the only way that a central bank can control that inflation is by rising interest rates. So do you see the way these Fed Fund futures have been moving higher, particularly since the start of the year? That's because the Federal Reserve have started to indicate to markets that they are more concerned about inflation than they are about slowing growth. So let me show you what I mean. If you look at equity markets, what you can see is that sharp sell-off in particularly NASDAQ stocks, that has been sort of the mirror opposite, hasn't it, of the Fed Fund futures. You can see as Fed Fund futures are moving higher, look, the NASDAQ is moving lower. Now, why is that? That's because stock investors are afraid that a sharp rise in interest rates, if it happens too quickly, it will be disruptive for markets. So why would that be disruptive for markets? Well, it's simply because of this. If growth is slowing, then that means companies' earnings will be hit and be less. It will mean their existing debts will become more expensive as interest rates rise, and taking on future debt will be hard. So future growth is hit. So all of that is a negative sign for stocks. That's why stocks, global stocks, have been selling off. Now, what the Fed's been telling us is that they're not overly worried about this correction in stocks, but they are more worried about inflation. So the narrative at the moment is the Fed's more worried about inflation, so they're going to be more interested in hiking rates. Now, you'll see on this chart, I've got this support area marked in. Why is that? Well, that's because the area where the Fed tend to change their approach is when stock markets fall about 20-odd%. Now you see that is the region which will be a 20% fall. Now, if you look like at NASDAQ, this is what quite a few investors have been worried about. They've been thinking, look, the Fed is making a policy mistake, just like it did in the fourth quarter of 2018. So this is the fourth quarter 2018, and what did the Fed hiked interest rates just as growth was slowing, and so we saw this sharp sell-off in stocks. And if you notice, look, that's when the Nasdaq fell 20%, right? And then we had a shift in policy from the Fed. So what this means is it's that 20% region where markets are expecting the Fed to change their view, and that, you know, that doesn't come into like about 13,000 down here on the Nasdaq, and it's about 3,600, 700, right, on the S&P 500. So now you see the context. So which one does the Fed worried about more at the moment? Rising inflation or slowing growth? At the moment, the Fed is more concerned about rising inflation. So that means as we head into the CPI print on Thursday, tomorrow, it's hotly anticipated because the markets are really, really focused in on it. Now, I want to show you, if you look at my blog, I've done a post on this today, right? Just to get us ready for Thursday's CPI data. You can have a look at this. I just want to explain that there has been some updates in market dynamics since. Put it in the chat box there, so make sure you have a look at that. And basically, we've seen the yield surge in anticipation of rate hike expectations. Let me explain that. I'll explain that here for us. Right, bond yields, bond traders are followed by FX traders because bond traders are very sensitive to rising interest rates. When bond traders sense interest rates are rising, they sell bonds and that causes yields to rise. So this rise higher in yields, can you see, look, since January, do you see the way that yields have risen higher? Why? Because bond traders are expecting higher interest rates. Now, this is the 10-year yield, and that's a 2-year. Now, the 2-year yield is called the front end of the yield curve. That front end of the yield curve, the shorter dated maturities, tend to be more sensitive to interest rate hikes. So they tend to move more quickly when they're expecting interest rate hikes. The 10-year yields, which I have on the chart, is the candlestick pattern, is more like growth expectations. Now remember, growth and inflation expectations are now expected to drop lower. So we are expecting these 10-year yields to eventually capitulate lower. Now, what would push them lower? A miss in inflation. That's why we're going to really focus in on inflation. It's a big event because it could be pivotal for the market. Now, the best opportunity is this. The best opportunity would be if the CPI print shows signs of slowing. Remember, this is my blog, so I've written all this, right? I only said that I shared this on Twitter one time, and someone said, "Oh, look at you, you know, you're sharing a blog post." And I'm thinking, well, yeah, it's the blog post I wrote. So just in case there's any misunderstanding, so the year-on-year headline is expected to come in at 7.3%. So we know inflation is very hot, above 7% for the above 7% for the US headline. A minimum expectation of 7%. The core is expected to rise to 5.9% with a minimum of 5.5%. So the best opportunity will come from a miss below the minimum expectation. So if we get a reading that's below 7% for the headline and below 5.5% for the core, that means the pressure will be off the Federal Reserve. They'll be less likely to need to hike rates. Should this happen, that means the US 10-year yields would fall, the US dollar will fall too. That should boost the euro, and also the best opportunity is in gold. Now let me show you what I'm looking for. First of all, let's just give ourselves a bit of understanding. Now, if you take a look here at the gold chart, right? And let me show. Right, okay, so here we go. Now what you'll notice is I've got 3 different lines on my chart. Gold in gold, helpfully, dollar index in red, and something called the TIPS, iShares TIPS Bond ETF in blue. Now that iShares Bonds TIPS ETF I'm using as a proxy for real yields. You might have heard a lot about real yields. Now the reason I'm using the TIPS is because this is updated during the US market hours, whereas the real yields is updated once a day. So I use TIPS because it's virtually the same as real yields, and it's responsive, right? It's decent. Now, what you want to see is when you see real yields and dollar moving in the same direction, that's when you get the best incidence. You see here, when you've got real yields falling and the dollar falling, what does gold do? It rises. When you've got real yields and the dollar falling, you see gold rises. Now, when you've got real yields and the dollar rising, you've got gold falling. Do you see? So when they're both moving in the same direction, that's the best opportunity. Now, what's happening at the moment? Something very interesting. Let me explain. Real yields are rising, okay? But the dollar is falling. So that's mixed for gold. So you expect gold to be more sideways, but yet gold is moving a little bit higher. So that tells us that there is some underlying bids in gold. And if we get real yields dropping lower, then all of a sudden you expect gold to surge higher. What might make real yields drop lower? A miss in US CPI inflation expectations tomorrow would be the perfect catalyst. Because if CPI inflation expectations drop lower, we expect 10-year yields to drop lower. You can see here, I've just put 10-year yields on the chart. That is the nominal bond yield, the 10-year yields. So if there's a miss, then you expect that to drop lower. And if that drops lower in line with the dollar, then you'd expect lots of upside in gold. So what's the trade? The trade I'm looking for is as follows. Right. So what you see, first of all, we have the Harami inside bar pattern. Talking about this to some traders recently. Don't forget you can get the financial source package. I do speak to traders there regularly. Move above the break of that Harami inside bar pattern. That's a bullish development. If we get a miss in the CPI tomorrow, look for that trend line to break. So what I will be doing if I get a miss below minimum expectations, so below 7% of the headline, below 5% for the core, if I get that, I'll enter long gold. And I'll be looking to take profit, first of all, 1870, then at 1900. That trend line can be shortened to form a symmetrical triangle pattern. So this could be a break of this level could open up the way to 2000. So you can see you got 1, 2, 3, 4 touches. If you're not sure how to trade the symmetrical triangle pattern, do check out my blog. There is a search function on the blog. And just type in symmetrical triangle, how to trade the symmetrical triangle pattern, and you can go through that there, right? So very, very helpful piece there for you. That is the top trading opportunity of the week. Now, what happens if it isn't a miss? If it isn't a miss, then it's not a trade. The other currency pair to trade would be the euro-US dollar. If there's a miss, you'd expect euro-US dollar to surge to the upside. Now, don't forget, the nickname for the euro-US dollar is the anti-dollar index. So if you just notice here, I'll put the euro-US dollar chart on the dollar index, and do you see how I've inverted the scale? So if I just uninvert the scale, what you see is when the euro-US dollar falls, the dollar index rises. When the euro-US dollar falls, the dollar index rises. When the euro-US dollar rises, the dollar index falls, okay? So there is a near perfect inversion. You see when I invert the scale, there is a very strong negative correlation between the dollar and the euro-US dollar. Why is that? It's because over 60% of the dollar index is made up of a euro component. So that's why sometimes people call the euro-US dollar the anti-dollar index. So if we see a disappointment and there's a big miss, we'd expect the dollar index to sell off and euro-US dollar to surge higher. So a nice way of looking at that is, let's just see where we could define and limit risk. What would be an obvious target? So if you get like a CPI miss, your obvious first target would be up at that 1,500, 550 region. Okay, that's where you'd be looking at. moving back into those kind of levels. Okay. Let's see if there's anything else obvious, but that will be on a CPI miss, and that's a very strong bullish candle. So that's strong rejection of that level. In fact, if we just looked at that on the 2 weeks, let's look at the monthly. Yeah, so that's that's a false break Harami inside bar pattern. It's a very strong upside pattern. But obviously it will depend on that CPI data. So that's the best opportunity that I see coming up, but you will need a miss in both of the events. Now, a couple of trades we've been looking at, just want to update you on those. The China A50. Now, let me put here, all these other countries, US, Germany, FTSE, Euro stocks, all of that has been rising. So not right, falling, because central banks are hiking their interest rates. Hiking interest rates quickly as growth is slowing means equity traders are nervous. But look at China's A50 index. You see how China's A50 index, look, it fell like 30% last year as growth in China slowed. Now, the People's Bank of China is looking at cutting interest rates. There was news out today that Chinese firms have been ordered to buy stocks by the Chinese government. And the fiscal stimulus packages are still to be released by Chinese government, and the People's Bank of China is expected to cut interest rates further. So in other words, supported the stocks. Now, we've been looking at this area. It's a key support area. This is a great area to define and limit risk. So what you can do in this region is you can buy into the China 50 index, stops just below that 14,500 region. As long as you stay above this trend line, stay with it. If price gets moved back below this 14,500, ditch the trade. But you're looking for a move higher, back up to that 16,400, 16,500 region. Ultimately, you know, a return to 18,500, 20,000 is not off the cards. And that could be a nice medium-term place to look at entering. So just be aware, the China A50, very interesting place. If that level does capitulate lower, and the risk to this trade is that China's growth still slows down. The PMI data out of China recently was a bit disappointing. So it wouldn't be a massive surprise if this dropped a bit low, but if it does drop a bit lower, look at this. We've got this massive demand level here coming in at 14,000. So you'd expect to find buyers on any retest there, and stops could just be placed 13,400. So the way I'm playing this is playing at market. I've been in for a while. I've got stops just below 14,500. If that capitulates lower, then entering again 14,000, stops just below 13,300. I think this offers good value for medium term. Don't forget to check your terms and conditions with the rollover. If you want to trade something a little bit easier, then you could use something like the MSCI Emerging Market Index, or like something for the large China large cap, something like that. MSCI Emerging Markets is a just check that it's got a strong China portioning. So make sure it's got a strong Chinese portion, particularly if you're not trading Chinese the 50 futures index. I'm doing both. I've got a 50 index for like a shorter term position, and then I've got like a longer term position which is running on the an MSCI ETF. We've looked at some medium-term trades on this webinar before. We're looking at the risk pairs, haven't we? We've been looking at the Aussie yen, New Zealand dollar yen. So we're just seeing them sort of pushing nicely up higher today. So we'll just cover those we're looking at. Yeah, you can just see, you know, New Zealand dollar CAD pushing higher. Looking at New Zealand dollar Swiss franc, that's breaking out of a key trend line. You know, it's worth having a look at. Just see that level. The important trend line after that one, the most of it is this one here. See, if that breaks and closes above, that's bullish. And stay above, stay with, get out, exit. We are just heading into overhead resistance areas, so that's an obvious place for some profit taking. Aussie yen moving higher up into that 83 region. New Zealand dollar yen. We've pointed this out a number of times. This good support level that is holding now, and you see the 10-year yield spread between the New Zealand 10-year and the Japanese 10-year yield spread. That's still pushing higher. Now the RBNZ are due to meet on the February the 23rd, and central bank after central bank has been revising up the number of interest rate hikes for the RBNZ. We haven't heard from them, so would expect a decent upside in revisions from the RBNZ in the next kind of like 10 days. Now, I just put on Twitter today. Don't forget to follow me on Twitter. I'm at Giles Cochran CCA. I just have a decent little tweet I put out, which is this, right? Look at the house prices in New Zealand. There's like a 28% year-on-year rise in New Zealand house prices. So how do you contain house prices? Well, you hike interest rates, because then people can't afford to buy expensive houses because it's too expensive, right? So that has to be controlled, that housing market. Now, New Zealand house prices are more expensive than US, Australia, Canada, Norway. So, you know what I mean? Really ripping. That has to be controlled. The RBNZ will move on that. And also that's a key way of controlling inflation, which is very high in New Zealand. And a lot of that inflation is due to house prices as well, obviously oil, etc., etc. So don't forget, my Twitter handle is at Giles Cochran CCA there. Do follow me along. Don't forget the blogs. Folks, I hope that's helpful. I hope that really gets you ready for the event. If there's anything you're unclear of, just please speak now, because you've got me, and you can speak to me if you've got any questions, anything you're not clear on. Yeah, Jabin, you're very welcome, Jabin. It's absolutely my pleasure. Yeah. Yeah, Max, I'm interested in financial source, but the monthly sub is a bit too high. Yeah. Are there any specials at some point? Keep on their mailing list, Max. Keep on their mailing list. Or like, the other things, if you've never, that's what I'd say, keep on the mailing list. Let me just have a think what else I can. Let me just think of any other way I can. I'm just racking my brains to see. Let me just look at something and see if there's a way to make it a bit better for you. Let me have a look. What I would say, keep on the mailing list, and what you might consider doing is like joining for one, joining like for 1 month, okay, and then cancelling and seeing if you get a better offer. Some companies have a so if you haven't, just make sure you sign up there. I've just sent you my link. I don't know if that makes any difference, but if you just sign up there in the chat box, if you haven't signed up, I do offer a service where I do a daily webinar for less of a fee. I'll show you. Yeah. So I think the first stop, port of call, check that out, okay? And as I said, you might want to join 1 month then cancel, because sometimes companies have a retention policy, don't they? You know what I mean? And they can offer a better price, right? So maybe try that. I hope that helps. Max, yeah, that's right. Macro, I love macro trading too, Matt. It's like I'm so convinced with it. Trading with the macros, trading with the technicals, it just works beautifully. Do you know what I mean? It's hard work getting your head around the stories, but once you've got them and you can see how it works, you can define and limit your risk. Like with this you know, like with this China A50 index, like that's such a good, it's just a lovely trade because like fundamentally we're expecting China's index to move higher, right? Now, of course, we don't know where it's going to happen, but we do know key technical areas. So that's why, you know, I'm confident to mention this because we've mentioned this quite a few times on this particular webinar. I was saying that this is the area to get in, you know, I mean, I've covered it all on my blog, you know, going back a few weeks, right? And you can just see, look, that's such a key support level. Look at this, you know, support, support, support. That's the place to enter. And if we're wrong, right, on the timing, just get out there. So what is a, let's say you got in a worst fill possible, yeah, and then what is a 3.65% hit when you're potentially, you know, and it's not out of this world to be gunning for like a 24% rise. You see? And then if that's not the turning point, then okay, you can have another entry there. Okay, you got to have a wider stop, 5.5% for it to make sense, but still pretty good. And then, you know, you can potentially make a, you know.
Just keep an eye on the max.
Anyway, yeah, okay, folks, take care. Look forward to being back here tomorrow. Have that good CPI data, right? Hope it goes well for folks. Take care. Come back next week. Let me know how it goes. Don't forget we're back here on Monday as well. Thanks, everyone. Have a great session. Bye.